think it was inevitable that President Trump and Powell were going to cross swords. The folks at the Fed are in a bit of a mess right now because depending on what indicator you pick, you can make an argument to ease or not. We had Christopher Waller out the other day saying we have to cut rates now. Obviously, that's how the folks in Europe feel. I think there is still an underlying concern about deflation because there is so much debt out there, and there's still a huge amount of debt in the commercial real estate, commercial space, generally private equity, that was financed during COVID at very low rates, and now they can't roll it. The whole private equity sector is becoming a train wreck. But this is not about consumers. So everybody's been waiting for this consumer recession to materialize, really for more than a year. Remember last summer, we were talking about lower rates. We were talking about a couple of rate cuts and a recession, and it didn't happen. There's absolutely no indication in the credit metrics from banks that consumers are yet rolling over. So it's a muddled situation at best. And Powell, last press conference, he was symmetrical in his views. He said, I can go either way. And I think that's fascinating. What I've told my readers, we have a premium service that covers a lot of banks and non-bank names. And I said to them, look, do your homework and go shopping. I think ultimately Trump is going to have to fold on a lot of his ask in terms of trade. He's going to be mostly focused on China and problematic nations. He'll cut deals with the rest of them. He'll cut deals with the Canadians and the Mexicans. He's just trying to see what he can get. This is classic Trump, right? If you've read the book, if you watched the movies, you've seen this before. What I'm trying to say to you is I don't think the world's going to end. And I think this could be one of the bigger buying opportunities in the market. But let's talk about the future. If we get a couple of rate cuts, if the Fed decides they have to act because the economy starts to slump, you're going to see a lot of stuff going on Wall Street. You're going to see banks probably benefit. You're going to see non-banks watching their assets evaporate as people prepay their mortgages and refinance. So it'll kind of look like 2020 again, which was a little bit scary for a while because rates fell dramatically. And you could see a scenario like that in the future because the context in the background is we still have a huge mess going on in areas like commercial real estate, multifamily real estate, places where people live are problematic. And I think the Trump people are going back to the old ways pre-COVID, and those are tough rules. So for example, the government loan market, Fannie Mae, Freddie Mac, they're all going to go back to the old ways of dealing with delinquency. That means we'll see a lot more people selling their homes. In fact, a grim statistic you'll appreciate, 60% of the home sales today are people leaving the market. They're not buying another house. They're being forced out of their homes because they can't afford to stay. That metric used to be like 10-15% historically. So that gives you a sense of what's going on. Look, the dollar has been on a tear largely because of the actions of the Fed. The world always runs here because, let's face it, 80+% of all foreign exchange transactions are in dollars. What Donald Trump is essentially trying to do is tear up Bretton Woods and take us back to something closer to World War I, when the U.S. was important, but it was really still a minor component of the global economy. We've been running the dollar as a utility for the rest of the world for 75 years, and it has a cost. The cost is inflation for consumers and for business. So, you can't just fix this overnight. His ask is probably a little ambitious in terms of time, right? And the other countries can't respond quickly either. They weren't quite ready for this. But Donald loves to fight. He loves to fight with countries. You can't get any better than that, right? But ultimately, there's a lot of politics here is what I'm saying too. The world's not going to end. Look, if you go back to a more conservative and more righteous view of the world and you are tougher, things like credit and delinquency, regulation. I think you'll actually see the Trump people spend more time regulating banks and much less time regulating non-banks. They're going to leave that to the states. So different focus. But overall, I think, it's a different world because, the 4 years of Joe Biden were basically throwing money into the street. They left a complete disaster in the housing space. They left a disaster at the FDIC where they still own most of the assets of Signature Bank. They didn't sell them because they were worried about those apartment buildings in New York City. This is a big problem. Multifamily real estate is the subprime today. 2/3 of that market has government cover. So, this is a political problem as well as an economic problem. I think one of the things we're going to see the term structure of interest rates come back. You're going to see risk premiums on the long end of the treasury curve for 10-year securities, 30s. They're going to go higher. Since last summer, in fact, spreads have been widening well before Donald Trump's election. So I think there's a lot going on here in the background. I wouldn't be surprised to see the dollar trade off. In fact, I think Donald Trump would like that. I said on Twitter yesterday, Scott Bessent, our Treasury Secretary, is kind of like John Connally with better manners. John Connally was Nixon's Secretary of the Treasury, and when the dollar got weak, he said, well, that's your problem. It wins in a sense that it makes American industries more competitive. We're going back to some old-fashioned concepts here because for a long time, the dollar was just assumed to be strong, and we had to live with it. So no matter how those terms of trade disadvantaged American companies and forced them to move their operations offshore to venues with cheaper currencies, now it's going the other way. I also think the fiscal situation certainly, justifies a weaker dollar. Congress has to start feeling the costs of their refusal to do their jobs. That's the bottom line. And, the notion that Trump and the rest of these guys on Capitol Hill are looking to cut taxes more, we should just leave things as they are and freeze spending. But they were unwilling to do that. I talk about this in the book. Americans, going back to our inception, have had a really hard time paying their bills. They love borrowing money, but they don't like taxes. And I'm talking about back to the 1700s. And I think it continues, by the way. I don't see any way out of this without crashing the ship, and I don't think the ship is going to crash necessarily. They hyperinflate. The Fed basically monetizes the federal debt until they can't anymore. It's almost like Argentina. If you look at Milei in Argentina and the progress he's made, turning that country around, we face the same problems in the U.S. Our society just refuses to accept limitations on their actions, on their consumption. And the net is that we end up with a federal government that is, pretty deep underwater. One of the things we talk about in the book is some recent research that was done, particularly a paper by a fellow named Josh Younger and Lev Manand for Columbia University Law School, where they talk about the legal basis of the Treasury market. Where did this come from? Did it just erupt out of the ground? Did people just decide, hey, let's go buy some Treasury bills today? No. They had to be sold. That market was constructed very carefully by the folks at the Fed in the 1950s. They created what we called primary dealers. Now, the only trouble is, in 2008, we annihilated half of the primary dealers. They ended up getting bought by banks. So today, the Treasury market is basically a carry trade with a lot of hedge funds using 100-to-1 leverage. That's the market for Treasury debt. And that's the big vulnerability that the Fed worries about more than employment, more than inflation. The single biggest mandate is keeping the Treasury bond market open. It doesn't break so much, but it forces the cost of funding up for the government. It forces a change in the composition of people who are willing to hold Treasury debt. I think you'll see banks forced to buy more of it. This will be additional financial repression on the banks, right? And it ends with the banks looking like they did at the end of World War II. If you looked at most of the big banks in the U.S., half of their book was government bonds because everything had been about government during the Depression, during the war. That whole 25, 30-year period was about big corporations, big banks, and the U.S. government as the financial source to make the whole thing work. And that continues on into the late 70s. That was when you saw non-bank finance come back. I cover most of the industry. We publish an index on the top 100 banks. And what you see is that the Fed's actions, inflation, other factors has slowly been pushing down asset returns. And it has been shifting more and more of that dollar of interest income that the bank generates to equity as opposed to debt. So the debt holders, the depositors are not getting paid, but the equity holders still are. It's a long-term trend. It goes back 50 years. I don't know if ripped up is the right word. It has slowly atrophied and decayed. It was a result of war. Nations of the world, after they came out of World War II, said, well, we're going to use the dollar as money, and we're not going to talk about gold anymore. So the whole construct was about enshrining the dollar as the benchmark, and all the other currencies, which had all gone off the gold standard right before the war, essentially accepted that status quo. We had balance of payments financing and long-term lending with the International Monetary Fund and the World Bank, and it went on for 50, 60 years, but now it's essentially run its course. I thought it was interesting. The finance minister of Spain was in the FT a couple of weekends ago, and he said, if it wasn't Donald Trump, it would be somebody else. The Americans are tired. And so I think this dollar imperium has run its course. And I think we're going to go back to more of a multilateral, compartmentalized world where currencies are going to become competitive again. This is why the Russians and the Chinese buy so much gold. They feel like, that's their backstop if they have to act for themselves. Now, do they want to grow their currencies big enough to accommodate all of their needs? No. That's not something you do voluntarily. That usually happens after a war. So you had Great Britain as the hegemon, then you had the U.S. take the baton after World War I when Britain was broke. All the European states were broke. And by World War II, we were the dominant provider of capital and everybody else was broke. It was easy to be a free trader in the 50s and the 60s, right? We had destroyed the world. But FDR during the Depression and World War II, he was quite protectionist. He was not talking about free trade at all. He makes Donald Trump look like the best free trader you could have.